As we said in previous analyses, the most important thing to do when investing money is to work on your trading strategy. Your capacity to stick to your trading plan will make the difference between success and failure. Indicators are often used by traders to decide when to enter and exit the market. However, choosing indicators is never easy, as you need to really understand them and know how to interpret them. One of the most popular mathematical indicators is the MACD indicator, which stands for Moving Average Convergence Divergence. This article will help you understand this indicator in depth, as well as know how to improve your overall analysis skills. So what is the MACD indicator? The MACD indicator was developed by Gerald Appel more than 35 years ago. It consists of 2 lines and 1 histogram. The indicator is usually at the bottom of your chart, as you can see in the image below. Its name comes from the fact that it compares 2 moving averages and displays when they are converging or diverging. A trading strategy based on the MACD indicator involves using buying and selling signals based on a potential price increase or decrease being spotted. Initially, Gerald Appel discovered this indicator to highlight when momentum and prices are accelerating together, as well as when prices and momentum aren't moving in sync. The indicator is therefore used to measure momentum comparing 2 moving averages. As we can see on the above chart, there are 3 elements that make up the MACD. The blue line is called the MACD line, while the orange line is called the signal line. The purple bars represent the MACD histogram. If you use this indicator on your trading platform, you will see that the default values are 12, 26, and 9, but you can change them depending on your trading style. Now let's have a look at these 3 components. Number 1, the MACD line. This line is one of the most important components of this indicator. This is the fast moving average. It displays the difference between 2 exponential moving averages, a 12-period EMA and a 26-period EMA. Remember that a moving average, MA, is a trend tracking tool, which displays the average price over a given period. There are different types of MA. The EMA gives more importance to the current prices. Therefore, this type of moving average will more closely follow the price action than others, such as the simple moving average, SMA. The EMA is more accurate because it is more reactive to price changes and new information available. For more information on moving averages, read our article, How to Use Moving Averages in Your Trading. Number 2, the signal line. This line is the slower line of the MACD. It's a 9-period EMA of the MACD line. The third component is the MACD histogram. The histogram is an oscillator evolving around the reading of 0. It measures the trajectory of the MACD and will help you anticipate crossovers. The bars simply display the difference between the fast and slow moving averages. As you can see on the first chart, each time both lines cross over, the MACD histogram disappears. See black arrows. This is because the histogram is the difference between the 2 lines. When they cross, the difference equals 0, so the histogram doesn't display any bars. This is usually when a price movement is about to happen, as the histogram gets bigger when the lines separate. We can calculate the different components by the following calculations. MACD line equals 12-period EMA minus 26-period EMA. Signal line equals 9-period EMA of the MACD line. MACD histogram equals MACD line minus signal line. That's it for now. On our website you can find more posts and podcasts. I hope you enjoyed it, and don't forget to subscribe to our podcast channel on YouTube. Do you use MACD indicators in your trading? If yes, are they the only tools you use, or do you use them in combination with other indicators? We would love to know your thoughts, so feel free to share them in the comments below.